Okay, good morning, guys. So today we'll be talking about introduction to forex trading, details about everything you need to know about forex trading. So let's move into that. So we have what is forex trading. We say that forex trading simply means foreign exchange market, and when we said foreign exchange, it simply means the exchange of two currency pairs. That's to say, the exchange of a base currency compares to a quote currency. So, what's a base currency? A base currency is the first currency pair in a currency pair. So, it is exchange of currency pairs, not more than pair. A pair is a set of two things. So, you cannot just have a three currencies here now. Let me say you have USD, NGN, and also you have GBP. No, it's just a pair of two, a pair of something. That's to say twos in twos. So we have the first one in a pair of currency. We have the first one is what we know as a base currency, and we have the second one to be a quote currency. So what do we mean by a base currency and a quote currency? If a base currency being the first pair in a currency this thing pair, if a base currency has highest momentum in the market will start pushing up to the upside. The market will push up to the upside. But if we have a quote currency in the market, if we have a quote currency to have more momentum in the market will push down to the downside of the market. So that's it for base currency and quote currency. When the base currency has more momentum in the market pushes up. When the quote currency has more momentum in the market will push down. So you will ask, what if both has the same momentum in the market? What will happen? That's when we say that this particular market is consolidating or it is ranging. It is neither going up nor going down, but it is ranging in um, in equal highs and equal lows. It is neither going up nor is it going down. So that's what we mean by both has the same momentum, shares the same momentum at a particular time. So when base currency is more have more volatility or momentum, we say market is going up. When quote currency started gaining more momentum, market will start going down. But when both shares equal momentum at a particular time, market will start consolidating or ranging. So moving on, we say that forex trading, which means in abbreviation we call it FS. FS means foreign exchange, which means forex trading it is the global market where currencies are being bought and sold. What we do in the forex market is just we buy and sell currencies. So we have other markets. We have like the options, we have crypto, we have futures, we have indices, we have commodities, we have oil. But in forex market, what we do in forex market is just buying and selling of currencies. That's just all we do in the forex industry. And the forex industry is the second most liquidity has the second most liquidity generated in the market. What do I mean by that? It generates the income flow in the forex industry. The income flow in the forex industry is capped at 7.5 trillion in a day. So what is coming in, the money flow in the market, what is coming in the market, the money that is being circulated in the market in a particular day is capped at 7.5 trillion in a day, in a particular day, in a single day, making it the second most highest um, liquidity volume in the market after crypto markets. So we have types of currency pairs. We have number one to be our major pairs, minor pairs, and exotic pairs. These are the three types of currency pairs we have in the market. And let's look into the major pairs. What do we mean by major pairs? As its name implies, major pairs means this is this is the most traded in the world, and it will always include USD. It will always include USD. Don't you ever forget that. A major pair will always include USD. So what what are its characteristics? It has high liquidity, and when we are talking about liquidity, it simply means money generated in the market, money flow in the market. So it means it has high level of money flow circulating in the market. That's what we mean here. And we said it has a lower spread. What do we mean by spread? A spread is the difference between what you buy and sell in the market. So a spread is the difference between a point you open up a trade in the market and a point your broker executes it for you. So for instance, here now, you place your order here now. Your broker executes starts counting your profit from here. So what do we mean by that? Your you open this trade here now, but this trade did not start at this first level here now to start counting your profit for you, but instead it starts counting your profit immediately it surpasses this second level here now. That's where it starts to count your profit. So from here now to here. So this means that at this point here now, let me say you are trying to your target from here now to here is $1,000, and because market has with this small this thing here now, small difference from this first one where market should start calculating your profit, and this second phase here now where market starts calculating your profit. So that small difference here now, instead of closing with profit of $1,000, you close with a profit of $995. So the difference between here and here is what your broker charges you. So we will look into that we will look into that deeply in our next video. So that same goes with sell. When market is selling, if you sell from here, market started selling from the second point. Okay, moving on. We have we have another one to be smooth price movement or action. Compared to other currency pairs we have in the market, a major pair will always have a smooth price action. That means it will have a smooth price. This is what you mean. If market is going up, market will go up smoothly. If market changes direction, market will change direction smoothly. If it's ranging, it will range smoothly. Nothing like market moving up, moving like this, then without any clear phase of if this market is moving up or down. Nothing like that noise. That's it. And examples of a major pair we have, we have 7 examples of a major pair. We have the EU USD, we have the GBP USD, USD JPY, USD CHF, AUD USD, NSD USD, and USD CAD. So these are the 7 examples of a major pair. And as a forex trader, you need to know this abbreviation. You need to know the full meaning of this abbreviation. We say that the EU is the euro, the USD is the United States dollar, the JPY is the Japanese yen, the CHF is the Swiss franc, and the AUD is the Australian dollar, NSD is the New Zealand dollar, and CAD is the Canadian dollar. You need to know this abbreviation. It needs to stick to your head because this is just the ABC of forex trading. As a forex trader, you need to know the full meaning of the abbreviations of the currency pair. So let's move ahead to the minor pairs. So we have the minor pairs here now. And the minor pairs we say that the minor pairs, they are also the most traded, only that they do not contain the currency pairs, the USD currency. So what's the difference between the major pair and the minor pair if both of them are the most traded? The difference here is that the the minor pair do not contain USD currency, while the major pair must contain USD currency. So we have its characteristics to be good opportunity. What do we mean by good opportunity? Do we mean that um, um, major pair do not provide a good opportunity? No. What we mean here is that minor pair is more beginners friendly than a major pair. Before you can spot a movement on a major pair, it might have already left you behind and start moving to the direction of the market. But a minor pair will always allow you as a beginner to spot good opportunities, before it even happens. The difference here is that the major pair happens too fast that it do not allow you, the beginners, to spot it on time. So most time you can spot it, but compared to the minor pair, you can easily spot an opportunity on time compared to the major pair. So that's it. The second one is different market behavior from major pairs. That's also what we have here now. It has a different market behavior from major pair, where major pair moves so fast and minor pair gives you opportunity to execute your trade or spot your interest or setup. So we have examples of a major pair. So this here now are the four examples of a major pair, four pairs in a minor pair, sorry. There are the four pairs in the minor pair. We have the EU, we have the GBP, we have the AUD, we have the JPY. So here now are the five currency pairs on a minor pair. So understand that we have four pairs in a minor pair and we have five currency pairs on a minor pair. We have four currencies on a minor pair, while we have five currency pairs on a minor pair. So we have first one to be the AU GBP, GBP JPY, AUD JPY, EU JPY, then EU AUD. So these are the everything you need to know about a minor pair. So we have our third one to be our exotic pair. And when we talk about exotic pair, we mean the pair of major currency pairs with a currency with an emerging economy. So we have it to be like a major currency pairing with an emerging economic pairs. So what's its characteristics? We say the number one characteristics of an exotic pair is high spread. So what do we mean by high spread? When compared to a major pair, when it is being compared to a major pair, for instance, we want to buy from here. We want to buy from this pair. On a major pair, it started reading from this pair. Our profit started reading from this level here. But on an exotic pair, our profit will start reading from this particular level here now, because it has a high spread depending on your broker, but it will always have a higher spread than a major pair. So what do we have here now? For instance, here now, we bought from this zone here now. On a major pair, our profit started reading from this level, but on a minor pair, on an exotic pair, our profit started reading from here now. So what does this mean here now? This means that if we are on trading a major pair here now, and our profit is $1,000, and our spread, the difference between these two here now is $5, and we close this trade with $995 instead of our $1,000 here. In an exotic pair, if our profit is $1,000 and we close this trade here now at this point, instead of making $1,000 here now, this difference here now becomes a difference of $100. So instead of closing on $1,000 profit, we are closing on um, $900 profit. So that's the difference between exotic spread and the major spread. So we also have lower liquidity, and I told you that liquidity is the circulation of money in the market. So on a major pair, more money is circulating in the market because it is an already developed economy that we are trading on. But on an exotic pair, we are trading a major pair, comparing it to an emerging economy, which means that there will be small circulation of money on the currency pair. So moving on, we have more volatile. They are more volatile in the sense that they move in spaces. They move in spaces in this form. Sorry for that. They move in spaces from here now. You see space, they create more space. Like they don't give clear price action, and they won't give you room for you to understand the market sometimes. So that's it. All I will tell you for that. So we have examples of an exotic pair. We have the USD NGN, we have the USD TRI, we have the USD ZAR, then we have the EU TRI. So we look into the full meaning of these abbreviations we have here now. We look into their full meaning, what their abbreviations and their full meaning, and I tell you, you need to understand. You need to know this full meaning of all these abbreviations because it is the ABCD of Forex, and as a Forex trader, you need to know that. So we have the NGN to be the Nigerian naira, we have the TRI to be the Turkish lira, we have the ZAR to be the South African rand. So moving on, we have the hierarchy of Forex trading. So when we talk about hierarchy of Forex trading, it simply means how money flows in the Forex market. How money flows in the Forex market. And we have our first one to be the central bank or government. We have our second one to be the major bank, or you call it our Taiwan commercial bank. You have our third one to be our institutional investors, or you call it your hedge fund. Then we have our third one to our fourth one to be the liquidity providers. We have our fifth one to be the brokers, and we have the retail traders. So what's the work of a central bank, and how do a central bank or government comes into this cycle of forex market? So that's what we'll be looking into now. How a central bank comes into this cycle is that central bank control the monetary policies. They control the monetary policies. In every organization, there must be a regulation. If there is no regulation in an organization, that means it will lead to a distortion. So what the central bank does here now, or the government does here now, they provide monetary policy and they set interest rates. These things, they are the key things needed in every working system. Number one thing is providing monetary, being able to control monetary policies, and you are able to also set interest rates. So they can also influence currency value in the sense that the policy they make can control currency value at a particular time. So its examples are the Federal Reserve, the Europe Central Bank. So we have the Taiwan commercial banks, or you call it the interbank market, and we say that these are the biggest players in the market. They are the biggest players in the market. Like they provide one of the biggest money liquidity that is being circulated in the financial market. They trade in billions of dollars on a daily basis. You can call them the Wall Street, and they provide liquidity to the market. If they trade billions of dollars on a daily and they are considered biggest players in the market, you already know that they provide the major liquidity to the market. And I tell you that liquidity simply means money. And if they are the biggest and they trade with billions of dollars, that means they provide the highest money in the market. Examples of this include major global banks. That's the example of a Taiwan commercial bank. So we have our third one to be the hedge fund, or you call them institutional investors. The hedge funds, they are the ones that manages assets, investment funds, pension funds, and large corporations exchange currencies for international businesses. They are the one that do all these things. So they manage investors' funds and assets. They are, you can also call them asset managers, or you can also call them pension funds. And they also um, um they also has um assets to large corporation exchanging currencies for international businesses. So we have liquidity providers. And why I use this ambulance as a symbol is, this is in form of bringing life to something. The liquidity providers brings life to something. So they gives hope to something. So they connect both the broker and the institutional investors or hedge fund. So it is the liquidity providers that connect these two, and they provide aggregate prices for multiple banks. What do I mean by aggregate prices? Like, they provide the prices of how what is being how things is being sold, the prices of the leverages on particular currencies. So they connect these two together, and we have our brokers to be the ones that provide trading platform for rated traders. And who is this rated traders? Rated traders is me and you, me and you. So these brokers here, they provide a trading platform for us. We have sorry, sorry, we have the trading platform to be the MT5, MetaTrader 5, MetaTrader 4. We have Match Trader there. We have Trader Casa. The brokers are the ones that provides us with. They are the ones that provides us with what's it called again? Trading platform that we trade on. And us, they also receive prices from liquidity providers. And I told you that liquidity providers provides aggregate price from multiple banks. So they receive price from the aggregate prices um, being received being received by liquidity providers from multiple banks. They receive prices from the liquidity providers, and they offer leverage to traders so that they can execute their trade. What is leverage? That will be topic for another time when we are talking about broker. So do where to check on my page to know what all this thing is all about. So we have now the rated traders. The rated traders are individual traders like me and you. They represent a small portion of total Forex volume. Imagine in a 7.5 trillion circulating in a 7.5 million dollars money being circulated in a system in a particular day. How do you think that your $1 million, 100K dollars, 10K dollars, your 1K dollars, your $100, even as small as your $10 can push the market? Hell no, that cannot happen. Instead, me and you now, we can only get access to this system through the help of our brokers, through the leverage they provide for us. That's the our only opportunity to be in this financial market. So we should always maximize our opportunity in this financial market. Have a way to utilize it and play it in a way that you manage your risk. Know that this is you are competing with someone trading in billions of dollars, someone regulating the system, someone managing investors' funds, someone helping your broker to generate to connect with the institutional funds. You know that you are competing with high level of individuals, institutions that have invested years in this system. So you should understand that and know that you are just a small player in the market, and you shouldn't treat yourself as someone who who controls the in and out in the forex market. Understand the system, understand how it works. It will definitely help you in your journey. And we only have access through this market. Rated traders only have access in this market through their brokers. So that's it for today. And do well to visit my channel because I will guide you step by step on how you can become a better trader from beginner's guide to professional trader. And it will help you in your forex journey. I hope this helps you. Thank you.